Well, good afternoon and welcome for joining us and investing your time or your lunch hour in this 30-minute webinar. Perhaps if we can just have a quick show of hands to make sure you can hear us okay and also see the presentation on screen. So I think on your toolbox you can sort of just quickly do a hands up to make sure you can hear us okay. Yeah, it looks like we've got a few show of hands there. Thank you. All right, well, once again, yeah, thank you for attending us today. We will commence, and we've still got a few joining us, but we'll kickstart right now because we've got 30 minutes. Due to the short time frame today, we're not able to take questions, and we will have an opportunity to email us at the end of the presentation, and we'll have a little reminder email that will arrive in your inbox tomorrow, just reminding you if you do have any questions. My name is Steve Holmes, and I have a pleasure in introducing Peter Crump today, our private client advisor of AMP Advice Wayville. Welcome, Steve. Peter.
Thanks, Steve.
And you would probably have met Peter a few times, and probably recently with the presentation if you attended the pre-budget or the pre-election webinar, because Peter delivered all those for us. But over to you, Peter.
Thanks, Steve. There's a lot to cover in 30 minutes, so I'll endeavour to move through fairly quickly. And if the sound isn't good for you, please let us know by typing in the message, but hopefully I'm assuming that you're receiving it loud and clear. So the purpose of today's session is to address the issue of how we can approach tomorrow with a degree of confidence following the budget. And one of the areas of concern that we had whenever an election is called is that we've got pieces of legislation that are on the table, that are being debated, or announcements that have been made that have yet to pass through legislation. And at the time of the election being called, there were over 100 pieces of announcement which had yet to be legislated, and that's a large number. It makes it very hard to make plans. So now we're post-election and post-budget. We can endeavour to approach the new world with a degree of confidence, but recognising that we've got some areas of budget announcements which have yet to be legislated. We've got some announcements where more detail is required, and we've got various implementation dates that have yet to be met. But one of the areas that we can approach with confidence is that the superannuation system not only remains unchanged from a perspective of no negatives, but in fact there are a number of positives in relation to changes affecting superannuation which are in the pipeline. And one of the areas that we didn't have as a result of the election was, of course, the changes to franking credits, which were part of the Labor policy. So at least the confusion and concern that existed around that is now well and truly off the table and appears to be a permanent feature of policy that we won't see in the future. But let's look at superannuation in the first instance. And most of the superannuation changes relate to people in the 65 and plus age group, but there are some changes relating to contribution banking, which we'll also be touching on. But the current rules that we have relating to superannuation contributions is that at the moment, age 65 is the important age for contributions being made to superannuation. Before age 65, contributions can be made without regard for whether the person is working or not. But once a person reaches their 65th birthday, it's only possible for personal contributions to be made if they meet what is called the employment test. And the employment test means that the person needs to be able to confirm to the superannuation fund that they've worked for at least 40 hours in a 30-day period. Now, that's the person's assertion that's made, and it needs to be made on a genuine basis, but there's very little policing or following up that is undertaken for that. Of course, it's quite likely that the person needs to have some type of PAYG statement or some type of employment statement that confirms at the end of the financial year that they have actually worked. And the question always gets asked of, I'm working on my investment trust, does that qualify, or I undertake charitable work? And unfortunately, in both of those cases, there are examples where that doesn't meet the work test because it requires that the work needs to be for personal exertion for personal gain, and the personal gain needs to be income received, not ancillary income such as investment income. So for people between 65 and 74, up to the 75th birthday, contributions can be made only if the person meets the work test of having worked 40 hours in a 30-day period. And once we get to 75, the only contributions that can be made are the compulsory contributions that must be made under the superannuation guarantee or award system. And as we'll talk about later, for people who have worked in the previous year but aren't working in the current year, there's a proposal in place to allow those people to make contributions in that next year where they're no longer working. And of course, we have in place the contribution that's available for people after they've sold their home, their residence that they've held for more than 10 years. In those circumstances, people who are over 65, even if they haven't met the employment requirements, are able to make up to $300,000 each of contribution to superannuation. And of course, there may be appropriate circumstances for that where it's beneficial to do so. But of course, the key issue is that must be undertaken within 3 months of the settlement of the sale. So that's the situation we have at the moment, where we have age 65 is the pivotal age, but we're proposing from 1st of July 2020 that 67 will be the new 65. So there's a proposal to extend the age up to which contributions can be made without regard for the employment test. Why is this occurring? This is occurring to synchronise the superannuation system with the Centrelink system. With Centrelink, the age at which the age pension commences for younger people is going to be age 67. So we've got some symmetry and consistency between the superannuation and the age pension system. So that's proposed from 1st of July 2020. It's a relatively harmless piece of legislation that's required, but it's going to be embedded with other probably more harmful, should I say, or debatable pieces of legislation where the government will want to package good and bad in the same process. Bearing in mind that we have to get these through the Senate, and up until the 30th of June we have the old Senate, and then come 1st of July we have the new Senate. There's a greater degree of control that the coalition government and related parties have over the Senate, but they still need to convince the minor parties that all of this is appropriate. So age 67 from 1st of July 2020 becomes the new age 65. And don't forget that the limits that apply to contributions remain unchanged. And this was an area where the Labor proposals were quite heavy, and they were suggesting that the limits on superannuation contributions would be reduced. And of course, the limits we're dealing with is $25,000 per annum is the maximum contribution that can be made from an employer, or personal deductible contributions before you get into some tax difficulties. And $100,000 per annum is the maximum contribution for the purpose of personal contributions which are not being claimed as a tax deduction, or non-concessional contributions. Non-concessional contributions are contributions that can be made in a lump sum. They're not deductible, and the normal rules allow for $100,000 per annum to be made without exceeding the limit. And there are special rules for people under the age of 65 when they start the process, where you can take credit for up to 3 years of non-concessional contributions. So we call that the bring forward process. So a person up to the age of 65 may contribute anywhere between $100,000 and $300,000, and in doing so, they commence the bring forward of the 3-year period. And once that process has commenced, it's possible, subject to meeting the work test requirements after age 65, it's possible for the person to continue to make the residue of the $300,000 aggregate amount over the 3-year period, which includes the first year in which the contributions are made. So it's an opportunity whereby you can make large contributions, and as long as you kickstart the process by making more than $100,000 in the first year, you've got the capacity then to bring it up to $300,000 over the next 2 years in big lumps. For example, in the first year, if you put in $101,000, in the second year, subject to the work test, you've got the ability to meet the full $300,000 by kicking in, for example, $199,000 to take up the full balance. So that opportunity has always been there, and we're now getting the opportunity under the new age 67 rules where from 1st of July 2020, assuming we get passage of this legislation, that the 3-year bring forward process can be triggered up to the 67th birthday. So again, 67 is the new 65. So what this means is it provides greater opportunity for people to put money into superannuation, provided they meet the rules. And of course, we've got a couple of rules in place, one of which is, are you eligible to do so? And if you are under the age of 65 now or under age 67 under the proposal, you can make these contributions. There's also another limiting factor, and that is if your balance in superannuation at the start of the financial year is too high, then you may not be able to make the full $300,000, and in fact, you may not even be able to make the full $100,000. And by too high, we mean over 1.4 million. So if you're over 1.4 million, there start to be restrictions on how much you can put in as a personal non-concessional contribution. If it's over 1.6 million, you are excluded from that ability for the next financial year, and the test is reset from that basis. The other area of contribution that is relevant is the spouse superannuation contribution. So with the spouse superannuation contribution, it's possible for contributions to be made by the spouse for the purpose of claiming a small rebate on for the paying person. So there are some tax advantages on the first $3,000 of contribution. It's possible to claim an 18% rebate on that contribution. So there are some tax advantages there. The interesting part about this is that it doesn't need to come from the other person's bank account. The tax law doesn't specifically request that it comes from a dedicated bank account that belongs to the second person. So contributions that are made into superannuation need to be labelled at the time they come in to say, is it coming from me or is it coming from my spouse? Because that's useful for the purpose of claiming the rebate in the next tax return. So under the current system, we have age 70 being the maximum age at which the receiving spouse can take the contribution, and also they need to satisfy the work test. And under the proposed changes, the receiving spouse will need to be under age 75, and of course we have that increased age at which the work test is not relevant up to age 67. So spouse contributions can be useful for some minor tax planning, but we also have the same rules in terms of can these contributions be made for people with large balances. So what we need to do is and of course we're 2 weeks away from the end of the current financial year. So the end of the financial year crystallises the opportunity for contributions to be made to superannuation or pension drawings to be made to ensure that everybody's position is optimised. So if you haven't yet had the opportunity to look at your contribution position, if you're eligible to do so, then it's probably a good idea to have a quick chat to your advisor to make sure that you're not missing those opportunities. Because once the financial year end has passed, and bearing in mind it's a Sunday this year, so there's 2 less contribution days between now and the end of the financial year, then take the opportunity by all means to make those contributions if it meets your circumstances and if you're eligible to do so. So please make sure that you seek appropriate advice. Of course, we've got normal tax planning processes of managing your income, if possible deferring your income by delaying asset sales until the next financial year, bringing forward deductions if you've got borrowing. So we've got standard activities that are occurring, and nothing changes with the prudent activities in relation to having balances in superannuation. If you're coming up to age pension age and you've got your younger spouse is not going to be eligible for the age pension for a while, then arranging for some of your superannuation balance to be moved to them by means of withdrawing if that's possible and contributing back to that person, or making sure that contributions are directed to the younger person. Alternatively, if you want to access your money earlier, then following the reverse arrangement whereby you're splitting contributions to the older spouse. So those opportunities exist at year end and should always be investigated with your advisor, preferably a little bit earlier than now, but certainly there's still 8 shopping days left until the end of the financial year. So by all means, give your advisor a call if that's appropriate. So if we can look at tax, and tax is fairly benign. in the changes the changes that were announced in the budget are a continuation of the changes that were announced in the previous financial year, and it's all part of a long-term change to taxes. Now, for people on higher incomes, it's a bit of a tease because the changes to the tax system are relatively small in the middle. They're intended to advantage the people with middle incomes by the use of some of the what's called tax offsets. And they're called tax offsets because they're not actually a reduction in the rate of marginal tax that applies in the middle, but it's a rebate or refund of tax that's a particular dollar amount in the middle group, which phases out by the time you get to medium to large incomes and is non-existent at the higher income levels. So we're still stuck with the 2% Medicare levy. Labor had a proposal that it might be increased, and we have the same tax brackets in place and the same indexation regime. Of course, we've already had the debate as to whether the minor parties will be interested in adopting these changes going forward. And bearing in mind, we're actually talking about legislation that has a 5 or 6 year roll forward. So there may be some reluctance from the minor parties to be committing this much in terms of the tax changes. But if we want to have a quick look at the changes that are occurring, you can see there that you've got a new feature called LEMITO, which is the low to middle income tax offset, which is supplementing LITO, which is the low income tax offset. And LEMITO is being used, it's $1,080 in the middle tax brackets, but by the time you get to about the low $100,000, it starts to phase out. The excitement doesn't really occur until the 2022-23 financial year, when there's a significant hike in the threshold at which the 19% rate remains before we get to the 32.5% rate. So you can see in the second column there that the threshold increases from $37,000 to $45,000, which is a significant increase. And that's why the LEMITO, as you'll see in the LEMITO of $1,080, steps out at that stage, because that's replaced by the increase in the tax threshold. And of course, that increase in the tax threshold is mirrored all the way through the other marginal rates. So everybody starts to receive a tax advantage at that stage, both medium and high income earners. And then we reach the ultimate stage in 2024, when we ideally are only going to have a tax system that has only 4 layers. And there'll be this massive middle layer of $45,000 to $200,000, which is taxed at 30 plus Medicare. And then we get the higher threshold at $200,000, which is taxed at 45. I like to wish that that's going to come in without change, but of course we've got potentially 2 elections in the intervening period. And while we have promises and commitments of ongoing budget surpluses over that time, there's a lot that can happen in the world economies in that time where I wouldn't be making plans on seeing that tax system in place. And in fact, we're seeing commentary from not only our Reserve Bank, but world reserve banks, that there's a significant weakening in the world economy, and there's some concern about the ongoing pace of economic activity. And of course, if there's reduced economic activity, that will reduce the tax take, which means that the surpluses on which these tax cuts are premised may be a bit weaker. So certainly look at the tax position for the pending financial year as being likely to be implemented. Look at the 2022 one as, yes, it's a promise and a commitment, but you've got to go through one electoral cycle for that to occur. So it's interesting to observe what type of tax improvement we're seeing between the 2019 relative to the 2018 year. And you can see in that middle income group, optimising up to $90,000 is the largest improvement in the tax position as a result of the lower middle income tax offset. And then it phases down after $90,000 and eventually totally diminishes at $126,000. And the only tax cut there is a result of a minor change in one of the lower rates. So depending on where you sit in that income position in terms of taxable income, you can see the likely effect and the extra money that might flow through to you. Remembering, of course, that payments from allocated pensions and private sector superannuation pensions after age 60 are generally not taxable. So we're talking here about taxable income when we're looking at these sorts of tax rates. So we can briefly touch on social security, and the good news is that we're getting some one-off adjustments which are made by means of lump sum payments, and these either should be in your account or will be in your account very shortly if you're in receipt of one of these pensions. They're not available for people with just the card, so the Commonwealth Seniors Health Card, for example, but it's intended it recognises that there's likely to be a significant effect of the increasing cost of power bills. So it's a means of providing a one-off opportunity to help people. These sorts of things will occur from time to time. They're not legislated or promised on an ongoing basis, but you will find that they'll be thrown in from time to time on an affordability basis and to attempt to make people feel more comfortable about offsetting their energy bills. I'm not sneezing at the fact that $125 is going to be helpful, but it's not likely to cover a large part of the increased energy costs, but every dollar helps at the moment. So we're coming to the end of the financial year, as I've mentioned, and this illustrates some of the areas where your thinking should be, and if you're under age 65 and able to make contributions, then you should be investigating the opportunity for making contributions. The 2018 year is the first year where people are able to make personal contributions while they're also receiving employer contributions and have those personal contributions eligible to be claimed as a tax deduction. Now, don't forget that you still have a maximum of $25,000 above which you shouldn't be going in terms of the combination of employer and personal deductible contributions. But certainly that provides an opportunity for people who may have some tax planning to undertake in the current financial year to consider whether there's the opportunity to put a greater amount into superannuation out of their own pocket and claim that as a tax deduction to achieve an improved financial position. Of course, that's an area where you need to seek appropriate tax advice that's appropriate for you, and also you need to then seek appropriate financial advice to make sure you fit the criteria of putting contributions into superannuation by means of your age, or if you're over age 65, your working circumstances. Being able to put money into superannuation to be eligible for the co-contribution, for example, which is still available for people with incomes up to about $40,000 or so, $37,000 phasing out to $43,000. That's still an opportunity if you want a minor tax supplement. For people on lower incomes where you're working, $1,000 can generate a $500 government co-contribution, so there's some advantages there. Of course, that needs to be weighed off against the requirement that once you put the money into superannuation, you won't be able to get it until you meet a condition of release such as retirement after age 60 or a permanent retirement after age 57. So putting contributions in can achieve a tax advantage, but you need to be mindful that you're depriving yourself of the money for a period of time. Making sure if you have a self-managed superannuation fund that you've met the minimum pension obligations, to make sure that you've paid the minimum to ensure that any tax advantages that you receive by virtue of having pensions in your superannuation fund are going to come your way and won't be lost. I should mention also on the self-managed superannuation fund side that there were some legislative proposals that didn't get through in relation to self-managed super funds, and the main one there is to extend the number of members that could participate in a self-managed fund from the current maximum of 4 to a maximum of 6. And it's highly unlikely to fit many people, but there are some family groups where they may have the 2 parents and more than 2 children where they want to participate in the fund, or they may want to potentially involve the partners of their children in the fund. So that's an area where we expect that to be put up for proposal and approval towards the end of the calendar year. And it's a fairly harmless policy change, but it may be used as part of the bargaining process by the minor parties. So for those of you with self-managed funds where you were contemplating having more than 4 members in the fund, that's still on the legislative radar. And of course, having a self-managed fund, it's important that you seek appropriate advice at year end to make sure that all your contributions have been properly received. You don't have the same diligence which occurs with an external fund where you can actually go online and see them as having been received. You need to check your bank statement, for example. For those of you over 65, if you're thinking of making contributions, make sure that you meet the work test requirements, because you will be asked to certify that by the superannuation provider, so 40 hours in a 30-day period. So there's a lot of things to be considered as always. Year end, it's a busy time, but it's an important time not to miss the opportunities. Hopefully in today's presentation, we've been able to quickly give you an overview of the types of issues that are likely to be changing, and you can work out whether you're going to be in the area of possible opportunity for these. If so, it's important to engage with your advisor to say, well, how do these affect me? And then your advisor can sit down with you and provide an explanation as to whether it's relevant to you and the advantages of you undertaking that, and possibly then proceed to the basis of providing formal advice about implementing those strategies. So that's the end of the presentation today. If you have any questions, because we've had to move through fairly quickly, please email your questions to the email address you can see on screen, wayville@ampadvice.com.au, and we'll make sure that your question is answered. If your question relates to your personal circumstances, we can then make sure that your advisor is involved in that response as well. So feel free to ask questions and raise them with us. But thank you for taking time to attend today's session. Hopefully it was useful to you to provide you with a very quick photographic snapshot of some of the key issues that are either remaining in place following the election, or which will be hopefully implemented in the next 6 to 12 months, so we can proceed with some certainty going forward. Thank you for your time today, and enjoy your afternoon.